Good day, everybody. We are back with another portfolio edition of the Explainer series. This week, we're going to change it up slightly. I'm just going to give a state of the union, some observations given what's going on in financial markets. It's been a little choppy to start the year. So we're going to look at the good, the bad, and the ugly. This is not a forecast piece, but it's not all doom and gloom either. So with that said, I hope you enjoy this. I hope this gets you to think a little clearer, have some context into what's going on, and ultimately to help you make better investment decisions. So let's get to it. I'm going to share my screen here. Hopefully you all can see that. So this is a similar format that I use for our market commentary video, where I just pull various graphs and then talk around what's going on. And first, let's just look at what's happening so far. So the market's a bit of a mess. You know, if you're just reading the headlines, it might seem like the world is ending, but the areas of pain have been pretty concentrated in the frothiest corners of the market, and namely tech and big tech. So what I have here on the screen is the Nasdaq QQQ, which is basically just a basket of 30 tech stocks, the largest tech stocks. And then I've included Apple, Meta, Facebook, Google, Microsoft, Amazon, and Netflix. And I want to be clear, there's nothing wrong with these companies. I personally own a few of them. A few are owned in pure models, but I'm just showing this for context. I mean, a lot of folks have piled into these names over the past decade, really, and they've been a great investment. But I think this is just a good reminder that there's no free lunch. There's no free lunch in investing. And what goes way up on the other side comes down just as quickly. So this is just a snapshot into what's gone on the first 25 days of the year. And you can see Netflix has really taken it in the teeth, followed by Amazon, Microsoft, the QQQ index, and Google, Apple, and Facebook. And I think this is also important too, because one of the themes that we've been writing about over the last year and a half really is, again, there's nothing wrong with these companies, but they're getting so large in size that it's really hard to go from a $1 trillion company to a $5 trillion company. So you're running into the law of large numbers. And looking at history, it's not uncommon for 5 or 6 companies to make up a good chunk of a broader index like the S&P 500. What is extremely uncommon, and I think this really does apply to technology because things change so quickly, is the reign at the top. The reign at the top of the corporate pecking order is often short-lived. I'm not predicting the demise of any of these companies, but it is quite common for companies to rise up and then fall off the mantle. So that's just something to look out for. And again, especially in the technology space, because investor preferences, what's in, can change so quickly. So that's something to keep an eye on. So this is just a quick snapshot of drawdowns through 121. So this is just the Nasdaq going back since its inception in 1972 and capturing drawdowns in the first 21 days of the new year. So this actually cuts off as of last Friday, I believe. And what we've just seen is the worst 21-day start for the Nasdaq ever. And I'll let you look at some of these numbers. A lot of people want to talk about 1999, but that swoon really didn't start until later on in the 2000s. So that doesn't register here, but you can see 2008 down about 12%, and then 2022 down about 12%. And a lot of folks want to draw comparisons to the 2000 bubble, the 1999 2000 bubble, to what's going on now. And the biggest difference is today's tech companies are much more profitable. So on average, today's tech company compared back then, so I'm looking at the Nasdaq, is about 50% more profitable. And if you recall the euphoria back in 1999, where companies would slap a .com in the company name and the stock would go up by like 50%. And a lot of these companies didn't have any earnings, didn't have any sales. It truly was a bubble. I don't like to use that word, but that qualifies as a bubble. So here it's a little bit different. Sure, the Nasdaq has pockets of froth. I think we're seeing that unwind a little bit, but know that the biggest difference between back then and today, these companies are actually making money, and in some cases, a lot of money. So one area that we track pretty closely is the semiconductor index. And semiconductors can be thought of as chips, right? And these chips go into everything from your laptop, your cell phone, your cars. One of the big issues with supply chains, especially for automakers, is they can't get enough of these semiconductors, which are more prevalent in the modern car. I mean, your car is like a supercomputer. So this is kind of like the new transports. So older investors, when our economy was more based on making things and shipping things, used to look at transports, the flow of goods, basically across the world and across the country. This, in my opinion, is the modern transports, looking at semiconductors. And given the supply chain issues and shortages, this has been a pretty good place to be as an investor. You can see through last Friday, the opposite has come to fruition, where a lot of these companies are starting to feel some pain. And some of these names, here's Intel, which is actually the exception here, but you look at Qualcomm, Texas Instruments is in here. So a lot of these big semiconductors have really taken it on the chin. Here's NVIDIA, which makes video game components, as well as computer chips as well. So this is just kind of a theme that we've seen. What has gone up the most has felt the most pain, at least to start 2022. So this is just a quick look at the S&P 500, which is the blue line. And this is as of today. So today's 125. And then I just threw in a gold ETF, some bond ETFs. This is a US Treasury 7 to 10 year Barclays Ag Index, which is basically a snapshot of the US bond market, a tax-exempt muni ETF, and another tax-exempt muni ETF. And I know bonds have caught a lot of flack just because yields are so low. They're not producing much in income. There's this inflation narrative that fixed income should not do well in a inflationary environment. And I would counter that with, one, markets like this are why you own bonds. Sure, they're, depending on the style of bond, some are negative, but they've really helped reduce overall portfolio risk. And the second part of that is, despite the Fed on the cusp of raising rates, despite inflation printing higher than it has in some time, you're not really seeing bonds respond in the way that you would expect. In an inflationary environment, you would expect bond yields to blow out. In a rising rate environment, you would expect bond yields to blow out. And by blow out, meaning they would rise, bond prices would go down. You're not really seeing that in a dramatic fashion, which tells me that bond investors, economists, analysts, investors aren't very excited about future economic prospects. So to counter what I just said there, during economic stress, during lower growth environments, bond yields tend to come down. And that's basically what's happening. It's a battle between future economic prospects and what the Fed is doing and inflation expectations. So if we're going to get good economic growth, if inflation is a long-term problem, if the Fed is as aggressive as some investors think, you would expect bond yields to move much higher. That's not really happening. Okay, so this is good for context. I like to zoom out a bit. So rather than looking at year to date or a 1 year chart, zooming out to show S&P declines from peaks from 2020 down here, so 120.20 to last Friday's close, which is here. And this was a dramatic drawdown from the COVID scare we had last spring or 2 springs ago. And then in September of 20, we had a 10% pullback. And since then, we've wrote about this a little bit. Since then, the markets have been fairly quiet. And then this is recently, which is probably a little worse after today's close. So call it 10%. So we're been pretty docile coming off a wild 2020, and then we're getting some noise here. But keep in mind, going back to the S&P's inception, on average, we get at least 10% pullback a year. So this noise right here doesn't feel very good, but it's quite normal to see the S&P do that in the course of a year. And then back to my point, not all S&P sectors have been crushed. Not all equity asset classes have been crushed. The worst of it is tech. You can see energy here is up 17% so far this year, had a great year last year, and energy was one of the worst performing sectors up until last year, where it was posting negative returns. It was a very small slice of the S&P sector weightings. That's completely shifted course. That's not uncommon. Markets move in cycles. The worst performers of yesterday are often the best performers tomorrow. Timing can be a little fleeting, but energy investors are being rewarded for their patience over the last year or so. And you can see emerging markets, which are this red line here, again, been beaten up over the last decade, have posted positive returns, but have really lagged US markets. So it's good to see emerging markets and even international markets, which is down here in the blue, hanging in there versus the S&P, which is down as of this recording closer to 10%. And then I included some other sectors that have held up well. So XLF is banks, the financial sector. XLP is consumer staples. XLU is utilities. So, there's been a theme. The best performers have been the worst performers this year. Out of favor markets have performed better, both on an absolute standpoint and a relative standpoint. Okay, so there's been a lot of talk about what the Fed is going to do. This is a great graph to understand what the market is pricing in. So if you turn on the TV right now, Bloomberg or CNBC, you'll get a talking head proclaiming what rates are going to do, and they're going to guess what the Fed is going to do. You don't have to guess. In the theme of taking our cues from the markets, the Fed futures, which is basically investors betting with their capital, trying to predict future interest rates, we can reverse engineer what the investors voting with their capital are predicting for future interest rates and Fed hikes. So how this reads, the light blue is what investors currently are expecting today. And this is the January meeting, the March meeting, the July meeting, and December meeting. So usually the Fed will only increase rates during their actual meeting times. So although the Fed will publish monthly reports, they only meet really 4 times a year to discuss formal interest rate policy. That doesn't mean they don't talk in between that, but this is the formal process. So looking at this compared to December 20th, so the dark blue is what the projections were back in December. And in less than a month, or a little more than a month, you can see how dramatically these interest rate forecasts and hikes are changing. So looking at January, so this meeting, the Fed is scheduled to meet Wednesday, I believe. The market is basically predicting 0 chance of a Fed hike, okay? And believe me, folks, the Fed does pay attention to this. So if they were to hike in January, that would catch the markets offsides, and you would expect the stock markets, the global stock markets, not to like that very much. This is much more likely, where we would get a March hike. That's what this is predicting now. So there was some people predicting that in March, but there was others not predicting a full hike in March. Now that is up to a full hike. And through July, the Fed, or these investors, are predicting the Fed increases about 2.5 times. And then finally, at the end of the year, when we look back and it's all said and done, the Fed would have hiked 4 times. So that's kind of the baseline. When I talk about Fed policy and market expectations, this is what I'm talking about. So anytime the Fed gets out of line with any of these projections, and these will change. So, you're not going to set your watch to this, as we can see from December, a month forward now, this has changed pretty dramatically. And I think this is why you're seeing some of the dislocations in financial markets, because this is a drastic change. Going from 1.5 hikes in July, a month later, you're at 2.5 hikes. That's a pretty significant change. So this is something that you should watch over someone talking nonsense on TV. Speaking of rates, there's a lot of talk about rates going higher, and rates have drifted higher from the COVID low back in this spring of 2020 to now. And this teal is the US 10-year yield. The orange is the US 5-year yield. And this, I guess it's silver or off-white, is the US 2-year yield. And this goes back a decade, basically from 2012, fast forward 10 years. And again, there's a lot of talk about rates, people getting nervous that rates are going higher. 1, rates are still historically low. And 2, we're going back here. We're at the same levels that we were in 2019, going back even further, back to late 2016. So it's not like we're decoupling completely and blowing out and seeing a 5% handle on the 10-year. This is still pretty range bound by historical standards. So I don't want to minimize what the Fed is doing, but let's not get carried away either. This premise, this table pounding that rates are going to blow out on the upside has been going on for the better part of a decade. It's probably the worst forecast that I can remember. And you get this corner of pundits and experts that keep repeating this. And it's not really a forecast if you keep repeating the same thing over and over and you're wrong. When you're eventually right, yeah, I guess you're right for 1 year, but you've been wrong for 12. So, it's less of a forecast. It's more of a guess. It's really hard to predict what inflation, what interest rates do, what bond yields do. And going back to my comments, I mean, there's a lot of smart people that have had egg on their face, perpetually predicting that bond yields are going to go higher. I'm not saying that they can't, but recent history has proved that this has been a tough barrier. This 3% yield on the 10-year has been a tough barrier to break through. And kind of driving my point home, so this is a matrix of global bond yields, and these are various countries: Great Britain, France, Italy, Japan, Australia. And these are the various maturities going from 1 year to 30 years. Where you see red, those are negative yielding bonds. So one thing that's always confounded me about the rising rate crowd, or rising bond yield crowd, is the US doesn't operate in a vacuum, right? A Japanese investor, a German investor can move capital with the click of a mouse. And if you're a Japanese investor and you could get -3 basis points on a 5-year bond, or you could click a mouse and get 6% in India or 1.5% in the US, that is an easy, rational trade. Capital flows to where it's treated best. So it's not like the US can decouple from the rest of the world and have these blowout rates. This red means there's a lid on US bond yields, okay? This has been true, really, the post-financial crisis. So post-2008, this has been a lid on US rates. And this was even more deeply negative back then. It's gotten a little better. Some of these negative yielding bonds, you can see, are close to being positive. But as long as this is the case, US bond yields are going to be an attractive bet for foreign investors. One, you're getting a sound currency. So when the stuff hits the fan, capital flows to US dollars. Two, you're getting the interest rate spread, right? Like I said, a Japanese, a German investor would find this to be a reasonable and rational trade. This isn't 1980 anymore where this trade would be impossible. This is very easy to do in 2020. Switching gears to earnings. So one thing we track, and it's still early in earnings season, where we've had 95 companies report so far. We look at the beat rate, so earnings per share, what percentage they're beating estimates, the higher the better. What percentage they're beating sales, the higher the better. What companies are raising guidance versus lowering guidance. And most importantly, how stocks react given these numbers. And what we're seeing is stocks reacting very poorly. And it doesn't matter if you have good earnings, it doesn't matter if you have bad earnings. Most of the reporting companies, their stocks are performing poorly. And in the case of blowout great earnings, the stocks are performing less well. So it just seems like investors' appetite for paying any price for stocks has pulled back a bit. Investors aren't blindly shoveling capital into these high flyers that are detached from reality. Investor sentiment, investor risk appetite seem to be changing. I'm not saying this is going to be a perpetual thing, but it's interesting how these attitudes can change seemingly without notice. And I think a great way this shows up is the response that investors are having to companies that are reporting earnings. And let's be clear, earnings have been okay. They haven't been great, they haven't been terrible, but the reactions have been very poor. Now, it's not all doom and gloom. There's some slivers of hope here, and I'm not a pessimist. I'm not an optimist. I take my cues from the market. I'm just reporting to you what I'm seeing. One silver lining to all this, and there's two I'm going to point out, but one silver lining to this is how high yield bond spreads, so lower quality bonds, cost of borrowing essentially, or cost of capital, cost of borrowing would be a little more accurate, have reacted during this market sell-off. Normally, and this is the red line here, lower quality bond spreads, meaning the cost for a less quality company to go out to the market and borrow, go up. during times of market stress. And by times of market stress, I mean a market sell-off. So this blue line is the S&P. You can see it's gone from 4,800 down to sub 4,500 in the span of 25 days. Normally, you would expect to see high yield bond spreads blow out. Now, this is inverted, right? So the further down we go, the higher the spread. And by spread, I mean, if we're looking at a 5-year high yield bond spread or a high yield bond versus a 5-year US Treasury, like that's the spread that's compensating you for the credit risk, for the interest rate risk, yada yada. So this is how we're measuring stress in credit markets. And you can see back in, this only goes back to 21, but back in the end of last year, credit spreads blew out some. And during times of stress, that's quite normal. That's not happening here. So high yield bond spreads have kind of hung in this tight range of 310-ish. And that's a good sign. So credit markets aren't stressed. It's not costing companies more to borrow. Investors aren't dumping their lower quality bonds despite this steep downward market sell-off. So that's a good thing. Credit spreads were a really good indicator back in 2020, not only of peak stress, which can do one thing, it can signal what's happening in markets, kind of the fear factor, but also it can mark a great time to get reinvested. So when credit spreads peak, that typically is a great time to add risk, meaning buy equities, and that's one of the rules that we closely follow. Finally, and this is, if you've followed my videos or writings, this is not going to surprise you, but we follow bullish sentiment. And right now people are feeling horrible. It's the lowest level since April of 2020. And bullish just means people are optimistic. And right now this is showing the opposite of optimistic. And I'm not saying this holds for all cycles, but what happened in April of 2020? People felt awful and markets basically went straight up after this point. So when people are feeling the worst, which they are right now, it's often a good sign to get more aggressive. I'm not saying that holds true every cycle, but humans are historically very poor at predicting, like the way they're feeling, that doesn't often manifest itself in equity markets. It's quite the opposite. So, I always tell people the best time to get more aggressive is when it feels the worst. I feel like there's a faction of investors that are sitting on cash or invested a little more conservatively than they usually would be. The time to add to equities is when you want to throw up. So it feels super uncomfortable when you're hitting that button or you're calling your advisor to say, hey, now's the time to make the shift. You're on to something, usually. So that's pretty much what I have for you. The biggest risks, in my opinion, and I encourage those that didn't catch my blog about throwing away the old playbook from last Sunday or last Thursday. But the biggest risks are really twofold. Right now, the Fed is using labor markets and inflation to make policy decisions. And I think that's worked over previous cycles, historical business cycles. But I would argue that the COVID economy, what's happening in this global pandemic, which is extremely distorted, increases the risk that a policy error is going to get made. And I can tell you, whatever you believe about inflation, you'd be hard pressed to disagree that COVID has distorted that picture. Exact same for the labor markets. So COVID has made this such a unique and almost fake business cycle that I'm afraid that the Fed is using an old playbook to make decisions based on what's happening today. And, that's just the facts. It's not an enviable position that the Fed is in. Chances are that they're going to make a mistake. It's always a risk to have a policy error derail what's happening in financial markets. I think that risk is at an all-time high. The second thing is I see a lot of investors, a lot of analysts making allocation decisions, sometimes large ones, so changes in their portfolio, changes in their asset allocation based on what's going on now. And it's kind of in the same vein as the Fed, where the COVID economy has distorted a lot of things. And I think investors find comfort in previous cycles, where we're at in the business cycle, where we're at in the market cycle. And I just think if you're making decisions today based on what's happening and extrapolating the current trends and current environment into the future, you're going to make an allocation mistake. Okay, there's nothing normal about what's going on right now. So my advice to you, would be to stay nimble, stay flexible, be able to change your mind when the facts change. Don't anchor to one identity. Don't identify as an inflation person or a pessimist or and build a portfolio that reflects the way that you feel about risk. We're seeing a lot of investors find out their true risk tolerance during this market sell-off. That's not the way to go about it. So I hope you got something from this. I hope this helps you think a little clearer so you can make better investment decisions, because there's a lot of bad information out there. Know that the mainstream media is producing content to get people to watch and to get advertisers to buy ads and spend money. So that results in spectacular headlines, a lot of headline risk. It's not helpful, it's not actionable, and it could lead to mistakes. So thanks for tuning in. Feel free to respond with a comment or feedback. Thank you.